So look at this chart where you see the entry here and the stop loss of 5%. The second chart where your entry is here and the stop loss of around 7%. And the third chart where entry is here, but again in the stop loss around 7 to 8%. So all of them had a decent, good chart, good setup, right? Breakout was clean, good tight consolidation, right side base. But the real question is, how much will you buy in these setups, right? Whether 10%, 20%, half your portfolio, 5 lakh, 10 lakh. How will you decide that number, that how much of your portfolio should go into these setups? Now, most traders decide this based on the confidence or some random social media stuff, but professional decide based on the risk here. This is what we are going to discuss today. Hi everyone, my name is Gaurav and welcome back to my channel. Today I will show you how to do a position sizing in a stock based on math, clear rules and no guessing. So let's deep dive. Okay, so now let's start with some of the concepts and then we'll discuss with the practical examples. So before we discuss about position size and everything, there is a rule which we need to define for any of the position sizing. So the golden rule is your risk per trade cannot be more than 1%. So for example, if today I'm taking one trade, my overall risk on that trade cannot be more than 1% of my portfolio. So, which means if my sample portfolio size is 10 lakh rupees, then in that case, overall risk I can do only 10,000, which is 1% of 10 lakh, 10,000. So this is the golden rule which you cannot breach, irrespective of how beautiful market looks like or how much confidence you have on your setup. It doesn't matter at all. And then second rule which I generally have kept for myself is that maximum portfolio open risk is less than 7%. So for example, let's assume that I have 5 trades in my portfolio and all of them has hit the stop loss today. So in that case, maximum loss, portfolio loss, which I'll see is around 70,000 rupees, which is 7% of my portfolio. Okay, so this is the standard portfolio rule which I have to follow. Now, let's imagine today evening I'm scanning all the names, and based on my setup style, which is something like this, where I look for a prior uptrend and then a tight consolidation, a decent long range or base formation, a right hand side contraction, and then the breakout happening at that from that base. That's my standard swing trading setup. So based on that, I identified this stock has a prior uptrend, and then a base formation, little deeper pullback, but then a okayish base formation, right side consolidation of around 5 to 7 days. And this candle looks okay. So what I have done is I have put a GTT order or alert around 110, 111. Whenever the breakout happen, basically my entry will happen. And the base consolidation base, I have put it as a stop loss. So there are multiple ways to put the stop loss. Okay, I have discussed in a separate video. I'll put a link over here. But in nutshell, let's say I have taken a consolidation or range low as my stop loss, which is around 5%. Okay, so at any point of time I'll be losing 5% approximately here. So as of today, when I have to take a position tomorrow, this is the max information I have. Right now, based on this information, what will be your position size? So there is a very simple mathematical calculation you can do, which is, if your portfolio risk is defined, which we have already defined, that maximum portfolio risk we can do is around 10,000 rupees, and the stop loss is 5%, which means I can allocate 2 lakh rupees in this stock. Okay, considering my overall portfolio is 10 lakh, which means around 20% of portfolio. It's a simple math, right? So it means if tomorrow I entered into the stock and it hit my stop loss of 5%, the worst case scenario I will lose is 10,000 rupees. Just to expand on the same, like what could be the possible position size and why stop loss is extremely important and why I'm big proponent of tighter stop loss, because of this reason. Imagine you have a 2% stop loss. With the same risk, you can allocate almost 5 lakh rupees, which is 50% of portfolio. If the stop loss is 4%, in that case I can go 2 lakh 50,000, which is approximately 33% of my portfolio. If I have 5%, 2 lakh rupees. 7, if it is 7% stop loss, basically 14% portfolio. And then if it does 10%, 10% of my portfolio. And if a 20% stop loss, I can allocate around 50,000 rupees, which is just about 5% portfolio. If you have a loose stop loss of 20%, 13%, 17%, in that case your overall portfolio size will go down, because your overall risk cannot be more than 1%. But if you have a tighter stop loss, which is around 4 to 5%, then in that case you can allocate quite big, keeping the same risk at portfolio level, which is around 10,000 rupees. Now, just continuing with the same example, but in a tabular format, here I have tried to put which position size is good for which kind of trader. So let's get rid of the bad one first. The f- you see the third row, which is a small positions loose stop. When you generally start in the market and you don't have understanding of position size and all, and you don't want to risk too much in the stock market, you basically start with this condition where you won't where you allocate very little of your portfolio, so just hardly, let's say 2.5% of your portfolio, let's say 25,000. If you have a 10 lakh portfolio with some loose stop loss 5 to 7 or 8%, if the stop loss been hit, you will hardly lose 2,000 rupees, which is fine. You're not destroying your portfolio. But when the stock moves up, go to 20-30%, then you are not making a decent upside also. So this is where, majority of the beginners start with. They are very conservative, limited upside. The next one which I wanted to highlight is high exposure. Now, some of the market participants who again have no understanding of position sizing, they sometimes want to put too much of capital or your portfolio in one stock. So they go very aggressive. They increase their overall risk to 2%, where they allocate almost 50% of their portfolio in one stock, though their stop loss is tied 4%. So if the stop loss being hit, they will lose only 20,000 rupees. But still, this is a quite aggressive, because even one or two gap downs will blow your portfolio. The best case are these two cases. So if you're a beginner and if you do not have a lot of market understanding, but you still want to make good in when the stock goes up, the first row is the best row for you. So in this case, what you're doing is you're still risking 1% of portfolio, which is around 10,000 rupees. And in that case, you are allocating immediately 10% of your portfolio. So because if at all my stop loss being hit here, worst case I'll lose only 10,000 rupees, right? So you are basically allocating a decent size of 1 lakh rupees of 10 lakh, overall portfolio. And in this case, if the upside comes, you will be able to see a decent return. And if it doesn't go in your direction and if a stop loss being hit, then you will, worst case scenario, you will lose hardly 10,000 rupees. So this is the best case scenario where 70 to 80% trader can actually perform. But then this is the zone where a lot of, you see, the USIC champions, or a lot of well-known trader like Kulamagi, Mark Minavini, or Dan Zenger, they operate here. This is only and only for disciplined super performers, because these are the people who understand the importance of stop loss, position size, and they know very well if one or two stock work in their favor, they can kill it. They basically start with a very large position, so they go 20-25% in one go. But here again, your risk size is again limited. You have only risk 10,000 rupees, 1% of your portfolio. So here that stop loss will be tied around 4%, and you are allocating 25% portfolio. So this is the zone where a lot of big super performer trader perform. Thus the core insight is very simple, that you only position size and stop loss decide whether you will die or survive in the market. So whenever you take a trade, you first of all identify your entry point. Based on that, a stop loss should be tight enough so that you can allocate a big position size in that stock, generally around 10% to 20-25%. Now if the stock goes in your direction, you'll make a good amount of money. But if your stock doesn't go in your direction, you're not going to lose much. You'll hardly lose 1% of your entire portfolio. Continuing with the same example which I showed you in the chart, so as of today, on the day one, when you took the position, so this is the snapshot. So your overall portfolio was 10 lakh. You risk 1% of that portfolio to enter into a position, so you risk 10,000. How did you risk this 10,000? By putting a stop loss of 5%. Now when you entered, the entry was 110 rupees, which means you have allocated 2 lakh rupees in that stock, which is around 20% of your capital. And with that, you bought a share of, let's say, 1800, 818. So you bought a share of 1818. So maximum loss you are expecting here is around 10,000 rupees. Okay. So basically you're deploying 20% of capital, you're risking 1% of portfolio. Your overall portfolio is quite balanced. Now let's say after few days, after 5-10 days, this trade worked in your favor and the stock went up, right? So how to add in any existing trade? This is the next question which a lot of people do ask me. Before going into how to add into a winning trade, you again have to have a rule here. So the rule is, you can only add if your existing risk has been reduced, or best case in profit. So my day one trade, which was initially when I entered at 110 rupees, until unless that trade has moved in my favor or the risk has been reduced, I personally don't add into that trade. The logic is simple, because the initial capital which I have risked is still under the risk, which is 10,000 rupees. Then why would I want to further add to that risk by adding more to that position? So until unless that position has been in a green, I am not going to add further into that stock. Okay, that is no exception. So let's explain with a chart. So when you entered over here around 110 rupees with 5% stop loss, now next day the stock moved up, and it immediately moved up and it gave you around 40% return, right? So you simply, the stock was moving up, and with around 20% of your portfolio you are riding this trend. At the highest point you had approximately profit of 81,800, and you are sitting on 8% of overall portfolio gain on this trade, okay, on your initial size, based on your initial size. So the first step which you want to do is, the when the stock moves in your favor, that you simply trail your stop loss on your initial trade. So what you want to do is, you either use your 11 or 21 EMA or your last consolidation low. When the stock broke out from here at from initial point, the stock went up, I am simply trailing 11 daily EMA. So let's just say that it is around 140 rupees, which is around 10% down from here. So what is happening here is, my worst case scenario, if the stock pullbacks and breaches this white line, which is 11 EMA here, I will still gain 26%, right? That's my worst case scenario in my first entry, right? So I am in gain. My old risk is gone. I'm basically protecting profit with the worst case of 27%. Once your overall risk has been mitigated, now if the stock moves in your favor, now you can think of adding into that stock. Once my old risk is gone, if I wanted to add into this trade, I will simply trade that new addition as a separate risk or a new trade. When you are entering here at entry 2, which is around 155 rupees, you are treating this trade as a separate trade, as a new trade. So in this case, your risk reward and everything will be exactly the same as we discussed earlier. So in this case, what will happen is, on day 12, let's assume that, on day 12 we are going to add the next tranche in my existing trade. So what we will do is, the entry point will be now 155 with the stop loss of 5%. Capital deployed would be again 2 lakh rupees. When you divide overall risk of 10,000 with 5%, you will see that overall capital can be deployed again as a 2 lakh. Now, if you divide with the price, which is 155, approximately 1290 shares you will be able to add over here. So what is the interpretation? That we only add after the stop on original position has moved up. Okay, if basically if you are in profit, and treat every add as a fresh per person risk decision. I'm not saying you add another 20% of portfolio, because 2 lakh is basically 20% of your portfolio, but it you're not expected to do that. You can definitely reduce to 10% only. So what will happen here is, let's say the worst case, my portfolio was 10 lakh rupees, I risked 1% of my trade. So the original trade was, my overall profit is around 27%. So worst case scenario, if anything happens, I will still make around 54,000 rupees in my on my original trade. And the new trade I have entered at 155, which is not a new trade, which is adding to the existing name, but we are considering it as a new trade. Okay, so we will basically say that we are here again, you'll put the stop loss of 5%. So in this case we will, worst case scenario, I'll lose 10,000 rupees. So what will happen if, as of tomorrow, my both the trades will hit a stop loss? So suddenly, let's say stop went down and my original trade also got executed, as well as my new trade. In this trade I booked a profit of 54,000, okay, which is my original profit. And on this added trade, stop loss being hit, and my loss was around 10,000 rupees. Okay, overall profit I have gained 44,000 rupees on this entire allocation, which is around 4.4% of our portfolio gain. Okay, so the key insight here for us is that even if both stop hits, the structure still guarantees a net positive effect. This is what we call a professional pyramiding. Now let's take a practical example. So this is one stock which I entered recently. I put it on the X also, and as I said, I don't use any Excel sheet or any position calculator. You might have, so I personally have, let's say, core and satellite portfolio, right? So core in separate brokerage firm and satellite in separate brokerage firm. So in morning, if I wanted to initiate a position, I simply open my brokerage account. I look on the top, what is my overall portfolio size. Now there is one tool in trading view which I will show you, which is this one. Okay, if you double click here, this is the long position. So how to add it? If you go here and if you go into projection, under that there is a tool named long position. You simply use that to do the calculation for you. So what I do is I have marked it as a favorite, comes here and sit in the favorite bar. Okay. Now look at the setting. So in setting, what you can do is you can put your account size. So for example, here the sample size I have put here is a 10 lakh rupees. Continuing with our example we discussed. Lot size ignore. Overall risk, as I said, we cannot risk more than 1% of my portfolio. So I have kept it 1%. I'll never increase it, but I can decrease it depending upon market. If market is not too healthy, then I will definitely decrease it. Like Equitas and all, I have literally reduced my overall risk here to reduce the position size. And entry point and all these things, it will auto calculate, so you don't have to do anything. So only these three things you have to update. One extra bit which I update here is this setting. So you go to the style, and the style, you remove everything else. You just keep quantity and these bits, stop loss bits. Okay, you just do OK, and the tool is ready for you to use. Now as I said, I don't use Excel and anything, so what I generally do is I simply open the brokerage firm app, I check my portfolio size, simply update the setting here with that portfolio size. Okay, now what I do is if I have to take any position, I will simply put this particular tool here, and I will adjust based on the stop loss. So if you see here, it's automatically calculating your position size, your quantity, depending upon your portfolio size. And at any point of time, if I increase my stop loss to, let's say, -7, -9, -10, if you are focusing any point of time, overall profit loss scenario is not going beyond 10K, because I have set that 1% of my portfolio size as a fixed risk of overall portfolio. So even if I increase or decrease, my overall portfolio risk will be always be 10K. But if I am increasing my stop loss, my quantity is decreasing to maintain that 10,000 rupees of risk. And if I am tightening my stop loss from 3% to 2% or 1.8%, I can increase my quantity to 286. Okay, so this particular a tool basically helped me. So what I did with Equitas, I simply put it over here. Okay, my entry was 18889, and I said the stop would be low of the candle, which is around 1816 or 1820 around. So I simply put it here around 3.65 as my stop loss. Now at this, if my portfolio size is 10 lakh rupees, let's assume, then I can allocate around quantity of 144. Simple. Okay, so I put my alert over here for the new addition. So when the stock went up, it formed again a tight consolidation here, and this inside bar breakout would have been my new entry. So around 2000 rupees I have put my alert, and I wanted to enter around this. But this addition or this entry I will treat as a new trade, because my initial original entry was already in profit. So I was in profit of around 7-8% at this point, right? Around 6.8, around 7%, let's assume. So I was already in the profit. So worst case scenario, I'm not going to go book my original trade in loss. It will always be in profit. Okay, so based on my trailing mechanism. So this one I will not gonna lose it. Now at this point, I can simply treat it as a new trade. I can see that my entry is around 2000. Maybe the base of this particular consolidation can become my new stop loss. Okay, so I'll just remove it to clean this up. Okay, so what I'll do is, okay, so this could be our new entry point, which is around 2000 rupees. And my new, based on, of course, I can do the setting changes, right? So what if in between I have booked some stock, and accordingly my overall portfolio moved up, right? So I simply change my account size over here, and also the lot risk. So I don't want to risk entire 1% here in my second second addition, so I can reduce here my account size risk. Okay, but let's assume that keeping everything same, I can risk around at the base of this low of this inside candle, which is around 2.93 risk. So at this risk, I can still maximum quantity I can go for 167. Okay, so that will become my second entry, and that is what exactly I did. I added again when the stock went up. I mean, as of now, it just pulled back, but overall, this is how I do it. So I don't use any Excel and all, and I keep it very concentrated. My overall position in a swing satellite portfolio is never more than 2 or 3. Mostly one, then sometime two, or worst case 3. So as of now, I have just have one stock, and I have decent amount of cash left in my satellite portfolio, which I need to deploy very soon. Okay, so hope this tool and everything help you to understand the position sizing concepts. It's fairly straightforward. It's not too complicated, but then there are a lot of reasons because of which we don't follow it. And just to quickly discuss why traders don't follow this position sizing rules. So the first one is greed over rules. They have no process, no mechanism to operate in market. They simply worry about taking a position in the stock and how to just get the profit out of it. So that's overall thinking or obsession is. Second, which I think or I feel that they don't have a knowledge or understanding of it, like what the position sizing means or how to do the calculation of it. Problem. The last is maybe the emotional decision, because this entire position sizing framework depends upon your discipline to execute the stop loss. Until unless you execute that stop loss, this entire framework won't work. And majority of the people, they lack psychology and mindset side of it. So start focusing on position size calculation. This will help you to trade some good trend with a decent allocation. It will also protect you if the trade go against you and the market is bad. If this entire video helped you, hit that like and subscribe button, and I'll see you in the next one. Bye.